see what we get for producer price index. All right, and the stock market just dropped hard. Gold dropped as well. Oil, let's see what we've got. That looks like probably a little bit of heat in the inflation department. And there it is. The actual came in, the producer price index month over month came in 0.5 compared to 0.3, hotter than expected. The producer price index year over year came in 2.2 as in line with, so this is a hot print. And so there you go. The stock market's down here on that news. Let's see what the damage is in terms of percentage basis. Yeah, you got about a 0.5% move lower in the NASDAQ. In the S&P 500, you're down 0.36. Again, let me reiterate, I could be very wrong, but this inflation figure coming in hot, I don't actually think is incredibly bearish for gold. So yes, it's dipping, but in my opinion, I think we stay supported and that the gold market continues higher. If I'm dead wrong about that, my stop loss will smack me and say, you were wrong, dummy. But again, there we go. So producer price index is out, hotter than expected inflation. One thing I will add context-wise today is remember that we are in the, hanging on the edge of a cliff here because CPI is tomorrow and so is Jerome Powell. So yes, you're getting a move here. The market is down to start the day, but I would not be surprised if we normalize after this or if we just kind of hover around this area in anticipation for what arguably is the bigger number, which is the consumer price index coming in tomorrow. So again, the producer price index came in hotter than expected. So Kenzo, what's your reaction to this hotter than expected producer price index number this morning?
Yeah, it's something that I was not really expecting, but not really surprising. But I think we're going to have a limited move for now because the most important one is going to be CPI tomorrow. So I think today we're not going to expect that crazy move, but tomorrow everything's going to change. But let's just expect maybe positive news. But if maybe we're going to see some like crazy hot, like what we saw now, yeah, it's going to be a different story. And the dollar is going to gain that momentum again. And the likes of NASDAQ US 30s, they're going to lose that momentum that we saw at the moment. And at the same time, it means that maybe they will be postponing about the rate cuts, and that is not going to be a very good thing. And later on, I think in a few minutes, we're going to have, in an hour, I think we're going to have Powell speaking. So if he saw those news, it's going to be a different story. I hope maybe his statement is not going to be that bearish, but we will see.
So the U.S. economy has been performing very well lately. We had growth last year of just over 3%, quite a strong year. And it's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income, consumers are spending. Generally, households are in good shape financially, they're not over-levered. And so we see a good picture. Consumer spending has held up very well.
Fuel importing area, so it meant that this was a very strong negative terms of trade shock, and this terms of trade shock of which we are recovering still also.
Just wanted to kind of highlight where we're at with that. So Jerome Powell kind of reiterated arguably a little bit more dovishness as he has been. And for newbies, new people, when I say dovishness, what I'm referring to is the willingness for the central bank to want to loosen monetary policy constraints. So cutting interest rates, making it easier for consumers, businesses, people to borrow money, and that is kind of stimulus in the system. So everybody is, you heard her ask the gentleman from the Netherlands about whether or not two rate cuts could be coming in the next few months for the ECB. Everybody's wondering the same thing. When are central banks going to cut interest rates? Jerome Powell was given the opportunity to talk on the producer price index here that we saw this morning, which was a measurement of inflation that tracks wholesale prices. They came in higher than expected, but Jerome Powell pointed out that they revised the previous number and that they look at that number as kind of a neutral whatever number. Again, he also mentioned that he still thinks that we can get interest rates, inflation down to the 2% target. He also mentioned that he still thinks, to the best of their knowledge, that the next move from the Fed will be a rate cut, not a rate hike. So again, we see a pattern here emerging with Jerome Powell. And by the way, I will pull him back up. We'll have him back on the screen if he starts speaking in just a moment. We have a pattern here from Jerome Powell of wanting to cut rates. It seems from his jargon, from his narrative, it seems like he wants to cut rates. And again, this is what traders have to do. You have to read through the lines of what these guys are saying. Yes, we had a hot print. Also, I took a look just for fun. The gentleman from the Netherlands, he mentioned that what has contributed to European inflation has specifically been the services PMI. You can see there is a services PMI on our software. It's been a consistent kind of problematic inflationary metric there. But I do think that they spoke a lot specifically about the kind of relationship between the ECB and the U.S.
Place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low rate mortgages, and now they won't move because they would be moving into a higher rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that policy is hitting the economy not quite as strongly as it would have if those two things were not the case.
Another opportunity for Jerome Powell to reiterate any sort of hawkishness. He denied it. What he just said right there, if you think about it, she just said, basically the question again, is the next move a rate cut or a rate hike? He said, next move still seems to be a rate cut, but we may need to hold for higher for longer. He also just mentioned, which I guess is actually positive for stocks, he thinks that monetary policy is restrictive enough until something changes. That would suggest, that it kind of supports his idea that we can just hold interest rates at where they're at. They don't need to go higher. Higher interest rates, again, how would that impact the market? Stocks would drop, gold would drop, the dollar would fly. But, where it kind of seems like we keep finding ourselves is, they're just going to hold at the worst case right now with the eventual rate cut. That's why I think gold continues to look really attractive.
In the United States, we don't have quite the constitutional, I think, support that you have for it. It's a statutory arrangement. It's an institutional arrangement that has benefited the public. And that's all it is. Congress can change it anytime they want. It would take Congress to change it, though. There's nothing the executive can do. I don't think that's likely, but as long as what we're doing is keeping our heads down, working on the things we're supposed to be working on, doing our absolute best and explaining ourselves as best we can, acknowledging mistakes and going forward, and that we will have the faith in our independence that we need, and I think we do have that now, and I'm determined that we'll continue to have it.
So in the aftermath, we have the S&P 500 dipped on PMI. The producer price index inflation figures, and then shot back up and then kind of followed through to the upside with Jerome Powell's, reiteration of his dovish stance going forward. It seems pretty apparent to me that he still wants to cut rates, but they're waiting for more confidence in the data. We've heard that a million times, so there's nothing outstandingly new to that. But I think that, now we have a little bit more data behind us. Like we have our first round of, inflation data came in mixed, while the other data points that we discussed earlier within, the Edge Finder, when we walked through like PMI data, GDP numbers, jobs data. If you weren't here for that segment, I highly recommend just rewinding. You can go through that yourself with us. But my overall point here is that we're seeing signs that the economy is cooling. Not that it was absolutely red hot, but it was pretty strong considering we've had 500 basis points of interest rate hikes out of the United States, and the economy doesn't just immediately roll over is pretty impressive. But Jerome Powell, he also mentioned something in there that I think is very worth mentioning. Perhaps now the U.S. economy is not as heavily swung by interest rates as it may have been in the past. A lot of the economy is services based. A lot of the big companies don't rely on debt like they perhaps used to. Like, you know, you can look at companies like Microsoft or Meta. These are companies that they don't need to borrow a ton of money, and they make up a huge portion of the economy, relatively speaking. So a lot of the, you know, the big tech names are not so debt sensitive. Also, he mentioned that people who, here's the frustrating part for those of you guys who want to buy a house someday. The frustrating part is that people who have houses and who have held on to them are holding on to also with that house some very sweet deals in terms of interest rates, you know, that they have to pay their mortgage. It's much more affordable than what would, you know, a new home buyer would need to pay in today's modern era. You can thank, for example, on that front, the rise in the, you know, interest rates trying to slow down the economy. You know, take a look at here's, you know, yields on a weekly basis over the longer term. We've seen them rise dramatically with the Fed's raising of the federal funds rate. And, you know, you take a look at all that, you say the economy's staying strong, yields are still very high, but Jerome Powell also made mention that he doesn't think that the next move will be a rate hike. In fact, he mentioned that he thinks the next move will probably be staying where we're at and eventually cutting interest rates, which would likely lead to that happening in the 2-year government bond. You can take a look at the 10-year if you want to look at that as well, but yields elevated, but he mentioned, you know, the overall forecast is for a rate cut in the future. Where does that leave me in terms of perspective? I think stocks can continue to push higher. As crazy as it might sound, you know, they've made such a big move, but you're looking at a you know, a stock market that's seen a really good earnings season. Relatively speaking, most companies beat. Tech earnings were pretty dang solid. The last one to fall, the last domino, I think, is the NVIDIA earnings, which come out May 22nd after the bell. So that'll be a big one for the market. But overall, it seems like, you know, this market doesn't have an adversarial Federal Reserve, right? Jerome Powell doesn't seem like keen on rate hiking. And so the market can kind of celebrate that. Earnings have been pretty good. To me, the stock market is not my favorite spot. Again, as I mentioned earlier, I continue to be long gold as kind of a very soft hedge to slowing economic data, because here's the downside to the stock market. If the economy slowdown that we're seeing is not necessarily a slowdown, but full-blown potential recession formation, if that's the story, suddenly you have a very different picture where you have, you know, the economy slowing, earnings could start to hurt, and that could bring the stock market down. So for me right now, I'm kind of neutral stocks. I'm bullish gold, as I do have positions I mentioned earlier. We're floating some trades on that. I'll go ahead and just show you the portfolio here, where we're at in terms of current positions. So let me go to positions here. I have some S&P 500 with covered calls sold on them. I have XLK. This is a technology ETF. I'm long tech with calls sold against it, as well as a bit of just a little slight hedge. I'm long gold, as I mentioned. Semiconductors, I've sold puts on that. That's looking pretty decent. Okay there. TAN, this is a solar technology ETF, which has done pretty well. Looks like I might get called away from my shares, which I actually wouldn't mind at all. But again, that's a 44 strike price, so we still got a ways to wait. If TAN continues to go up, then awesome. It's a small position in the portfolio, but it is a position nonetheless. Take a look at Bitcoin. I have a small short position on Bitcoin, which is a whopping $66 in profit. TLT, this is bonds. I'm long on bonds. Again, I think that rate cuts are probably coming at some point this year. Could be maybe one rate cut this year towards the end. That's where I feel like I'm at. But again, that would be positive for bond prices if yields started to fall. And I've also sold calls against it in the meantime. So I'm collecting some premium against my position. In terms of the S&P 500, as I mentioned, you do have a positive day for S&P. We'll see if that can hold. And the big data point for the rest of this week is going to be CPI and retail sales, which will show us a little bit of an insight into the consumer. If you're someone who watches my channel and you're from outside of the US, I want to tell you quickly about our top broker partner here on the channel, Eightcap. Eightcap is regulated by ASIC and SCB, and through TradingView, you can actually trade directly with your Eightcap account. They also offer very competitive spreads and commissions. They have a wonderful support system and team, and you can trade anything from Forex pairs, commodities, indices, and even some select stocks. Check out Eightcap using the link down below in the description, and there are some special sign-up perks if you use that link down below again in the description. Thanks for watching.